Broadcom is known as a premier designer, developer, and supplier of a broad range of semiconductor devices with a complex digital and mixed-signal complementary metal oxide semiconductor-based devices and analog-based products. This is according to Zacks Investment Research. As you can see by the powerful Fast Graphs Fundamentals Analyzer software tool that I think every investor should subscribe to, Broadcom has put together a very impressive growth rate since going public in 2009. Their earnings have grown at over 32.36%, and that would be the PE ratio, or the value of this orange line. However, you should also note that the market has traditionally valued this around more or less 15 times earnings. The blue line on this long-term graph is 14.78 times earnings. But as I shorten the time frame, you can see that a 14 multiple has been a clear proxy of fair value. One of the beauties of the Fast Graphs research tool, it doesn't dictate fair value, it reveals it for you. So even though the company has grown at a very fast rate, the market, the blue line, the normal PE or market PE ratio has been around 15 times earnings, which is a good valuation model. As I shorten the time frame on this graph, which is one of the major benefits of having a dynamic tool like Fast Graphs, you can see earnings growth has fallen to 25.98% since 2013. But once again, we still see that 15 multiple being a really strong proxy for value. Shorten the graph some more, and we see the growth has dropped to 18.41% since 2017. And incidentally, this company has a fiscal year of October. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. Welcome you once again to one of my Analyze Out Loud videos on AVGO, the stock symbol AVGO, or better known as Broadcom. This is a stock that I've been requested to cover several times, and I've waited because I've been watching the company, and I will, for disclosure, I do have clients that are long this stock and have been for some time. But right now, the stock has come into what I'll consider to be really attractive valuation territory. And I think the company offers the perfect, trifecta. It offers growth, it offers income, and it offers value. So as I go through my Analyze Out Loud video, I'll let you make that decision for yourself. But let's get into the Fast Graphs and analyze the company out loud together as I go through Broadcom for you. Now, as you see here, this is adjusted operating earnings. One thing I want to mention about Broadcom is that the company has been growing through acquisitions. They recently have a pending deal with VMware, and they're asking actually to be able to get an early acquisition to it. You can look that up. You go into sites like Seeking Alpha and find that out. But going back, in history, this is a really kind of an interesting company. A lot of people don't know it by the name Broadcom. But according to Wikipedia, Broadcom was established in 1961 as HP Associates, a semiconductor product division of Hewlett-Packard. The division separated from Hewlett-Packard as a part of Agilent Technologies in 1989 and was then renamed Agilent Semiconductors Products Group. Then in KKR and Silver Lake Partners acquired the chip division of Agilent in 2005 and formed AVGO Technologies. They paid $2.5 billion, a little more than $2.5 billion. AVGO Technologies agreed to sell its solutions to PMC Sierra in October of 2005. And you can get all this information on Wikipedia, and I'm going to kind of stop there. But the company, recently in 2016, merged with Broadcom, and then they used to go under the symbol BRCM, but they've kept the Broadcom name, but they formed what now is called AVGO. It was formed AVGO Technologies, and they've kept it, under the symbol AVGO. So this is Broadcom. Very interesting history, very interesting company. What I want you to note is the consistency of the earnings growth. Now, when I use the long-term growth rate here that I showed you, this is why I want those of you who are subscribers, this is a powerful analytical tool, but don't just look at the picture, analyze what you're looking at. So you can see this company in 2010 had a very extraordinary, acceleration of growth, and again, due to mergers and acquisitions. And then that growth rate began to slow down. You see that detailed information here. That's the beauty of Fast Graphs. We provide so much detailed information that you can analyze. But just by calling out that 1 year, you can see that the growth rate changed and you get a little clearer perspective. But once again, we stay around that 14, 15 multiple. I also want to remind everybody that the fair value multiples are always a range. When I'm showing 14.36, I'm thinking of something like 14 to 15, 13 to 16. We're trying to get an idea of where fair value is. It can never be a perfect calculation. It should always be thought of as a fair value range of calculation. But as you can see, as I go through this and shorten the time frame even more, a 15 multiple has historically, since the company's been public in 2009, a really attractive or a consistent fair value. And anytime you could buy the stock below that PE ratio, a PE ratio of 15, which is an earnings yield of 6.67%, then you get a really, good entry point. And that's where the company is now. It's currently trading at a blended PE of 12.19. It offers a very high earnings yield of 8.20%. Those of you who follow my work as Mr. Valuation know that I'm looking for at least 6.5 to 7%. This exceeds that at 8.2. It has a very attractive dividend yield of 3.6%. And I want to talk about the dividend a little bit. And I can see all this by looking at fast graphs. When they instituted their first dividend in 2011, their payout ratio was very low. The area below this white line, the white line is the dividend area. The green shaded area below the white line is the payout ratio. You can see in early years they had 17% payout ratios. And then that payout ratio increased into about 25%. And then it increased even more. And currently, if I take the price off the graph, you'll be able to see this easier. It's now paying over 50% of its earnings and cash flows out in dividends, but the dividend has been growing tremendously. And again, you can see that the company's performance has tracked its operating growth significantly. And I think that's very important. If we look at a 32.36% and go into the performance report of FastGraph, we see that the first dividend in 2011 grew by 66%, 41, 42, 37, over 100% in 2017. And this is when AVGO and Broadcom kind of got together. And then we've got 71% growth, 50. Now, the last couple of years, the growth has been slower, 22, 11, and 14, we'll call it. But it's still a very fast growing dividend company. And I think that's really important. So not only do we get attractive valuation with the price trading below what the market typically likes to value it at, so we get some potential PE expansion. I'll get into forward growth here a little bit later, but you've also got really good valuation and a nice high dividend yield that I'll show you later is very well protected by their cash flows and so on. Now, a couple other things, since they've been, the company has been growing by acquisition. That's really their goal and objective, and they've been doing that. So one thing to do is to go look at things like diluted earnings, which is GAAP earnings, and you can see that there's where you get a lot of accounting convention, where you get accelerated depreciations and other recurring one-time charges and events. So what this shows you, I don't really like to look at diluted earnings from a valuation perspective, but I like to look at it to see what's been going on inside the company internally. Operating earnings are kind of a kiss and cousin, if you will, to operating cash flow, which we'll get into in a minute, which are critically important when you're looking at a high yield dividend stock like this. So let's go ahead and do that. Let's go to operating cash flow. The first thing I want to point out is operating cash flow. And I'm going to take the normal PE off the graph. The fact that you can manipulate these graphs is such a very important feature of fast graphs. You can see that cash flow has consistently covered the dividend by a very high margin since the company has gone public. And even the more important, free cash flow, has also covered the dividend, except for it was, just barely covered it in 2014, but they even covered it during the acquisition and the merger with AVGO and so on. So the company produces really great cash flows, and the cash flows have really well covered the dividend. EBITDA, which is another form of cash flow, and I like to also use EBITDA sometimes as a valuation metric. As you can see, the stock price here, we've got the normal price to EBITDA of about 13. There is no blue line on this graph because we only calculate the normal price to EBITDA on the EBITDA graph. And as you can see, the stock is trading at a discount to its normal valuation of about 13 times EBITDA, currently trading at 9.1 times EBITDA. So once again, I consider that very attractive. Now, I do also want to make, well, let me go on. Let me finish this. I also want to take a look at one other metric here before I go any further. I want to look at sales. Sales has grown, nicely. And, if I shorten the time frame here, you can see that the company is trading pretty much in line with its price to sales right now, normally. And I'll get into the future as I go forward here. So, we've seen that the company has a great past, a great history. The market valuation, we can really, kind of hang our hat on the fact that the market likes to put somewhere close to a 15 multiple on this stock. That's where the stock typically likes to trade. And when you can get it below that, those have always represented in the past bargains, and I think represents it in the future as well. Now, growth rate has been slowing down. As I shorten the time frame, you can see the growth rate, going back to 2020 has only been 15.75%, but I say only, that still classifies it, in my estimation, as a growth stock. So let's go ahead and let's look at forecasting right now, calculators. Now, this is one of my pet peeves. Nobody ever likes anybody that insults their children. And although I have my children and grandchildren and love them, to death, I also look at FastGraph as kind of a surrogate child, if you will. And I really hate it when people criticize it unfairly. Fair criticism is one thing, but to criticize it unfairly. One of the criticisms I've gotten a couple of comments just in the last video, was that we rely too heavily on analysts. Well, that's really a whole line of malarkey, in my opinion. What we do is we provide you an opportunity to, first of all, start out by conducting your comprehensive research and due diligence by evaluating what the leading analysts, people that are professionals that are paid, are thinking about the stock. But we also give you a lot of granular detail. For example, there are 25 analysts forecasting a 33.4% growth rate for 2022, and it really hit, it came in at that number. And then we've got 25 analysts looking at $40 estimate for 2023, and then $44, an 8.44% and 8.93. Now, what I also want you to note, analyst estimates change, okay? And the analysts have been increasing their estimates. Historically, they increased it several times for 2021, and I want you to note the company exceeded it. They exceeded the estimates, and then they dropped it for the final year, and then you have estimates that have been slowly increasing for 2023 and 2024. Okay, now, one of the other criticism or comments can say analysts are wrong 90% of the time. Well, first of all, analysts are constantly adapting and adjusting. But what we've done in FastGraph, we've created an analyst scorecard. And an analyst scorecard measures how accurate analysts have been when they were making a forecast 1 year in advance, not a month in advance, but 1 year in advance. And then we also show the record of how accurate they have been when they make it 2 years in advance. Now, what's interesting about Broadcom is, yes, if I go to the 1 year estimate, the analysts have been wrong 67% of the time. However, they've beat the estimates. The company beat the analyst estimates, so that's a very positive thing. And this is with a 10% margin of error. And then on the 2 year forward with a 20% margin of error, they've also beat the estimates 55% of the time. Now, this tells me the company guides analysts correctly, and the analysts, find this company relatively accurate to forecast. Now, not all companies have this excellent a scorecard. Broadcom does. So what does that mean? That simply means if I'm looking at the forecasting graph on Broadcom, I know it's going to be wrong, but I believe it's going to be right within a reasonable margin of error, and I have a very high confidence level in that based on the analyst scorecard, which has been exemplary, as I just showed you. Now, in addition to that, we can look at historical compound annual growth rates, and you have a drop-down window here, so you can look at the growth rates of this company historically. And as you can see, the growth rate has, kind of slowed down here in recent years, but you can use any of these years as a proxy for growth if you want. That's, Ben Graham talked about that. And then you also have, you can go into the custom calculator. You can include the estimate data with the long-term growth rate if you want, but you can also input your own estimates and your own data if you've conducted further research. And in talking about that, FastGraph gives you external links. Some of them are free and some of them you have to subscribe to. One of the best ones, of course, would be going directly into the company's corporate website. You just simply click on the name and it takes you into the corporate website. And from there, you can look at, all kinds of information. You can go into investor services. You can look at presentations on any company, not just Broadcom. So you can continue to conduct your due diligence. You can also go directly into companies like Seeking Alpha, where you get crowdsourced research and you can see a lot of news items on the company, as well as a lot of opinions of a lot of their analysts or their crowdsourced analysts who are writing about it. We also have a direct link, if you will, an external link that takes you into things like Google Finance, where you can just click on it and go directly into Google Finance. And here you can find news items and so on. In a lot of cases, you'll get the same articles that you saw on places like Seeking Alpha. You can also go into paid sites, which I'm a subscriber to, both of these. You can go into places like Zacks Research and you can look up Broadcom, and get their analyst report. And from Fast Graphs, you can also go into other sites like Morningstar and see what Morningstar position on the company currently is. And you can see they give them 4 stars, and they talk about here, you get a lot of information, like Broadcom is now in the process, as I mentioned earlier, of acquiring VMware to address hybrid cloud opportunities. And by the way, with Fast Graphs, you can also then go and look at VMW, which is VMware, as you're going through your research process, and see what the analysts are saying about VMware. But you can also look at the historical record of VMware, which, by the way, is a non-dividend paying stock, but they're attempting to buy VMware at a very reasonable price relative to the company's, the way the market's been valuing it. So the tool gives you the ability to have so much power at your fingertips that I just, again, can't understand why everybody doesn't subscribe. But a lot of it, you have to understand how to use the tool. And that's part of what I'm trying to go through here. So forecasting, the analyst scorecard, the ability to do your custom forecasts, be able to see what analysts are and see how accurate analysts have been, is a great starting point to a more comprehensive research and due diligence process. Now, additionally, we also provide the ability to go into historical data, like we can go into the financial area of Fast Graphs, and we can look at things like free cash flow covering the dividend. And I'm going to shorten this to 10 years here. You can see that their free cash flow has covered their dividend beautifully. We're seeing operating cash flow has grown at a rate of about 27%. Regarding share buybacks, they've been relatively benign lately. And I want to remind you that the company was pretty highly valued in 2018 and 19. Their operating cash flow, other than 2018, has been above their net income, which is critically important. They're growing through acquisitions, and you can see they've generated very good sales growth. Their net income has grown very nicely. Then their debt to equity, the company is, one of the negatives of the company is they do have about 60% debt to capital and about 60% debt to equity. So that's something to, think about. Looking at them from a margin point of view, the company has, good margins across the board, and their asset turnover to sales has been, good. Their return on assets are good, but I want to show you something here. You can go into the quarterly data here and look at the last 20 quarters, and I want you to notice that their return on assets have been increasing. The return on equity have also been increasing over the last several quarters, and the return on invested capital has also been increasing. So all in all, I see this as a very, very healthy company, and I see it, that it does appear to have a bright future. Not only do analysts think that, but there's a lot of other research services that do as well. So, when it comes down to the bottom line, if you're looking at the company and looking at it from a standpoint of the normal multiple, which I tried to establish what I think is the most prudent way to look at Broadcom, you've got, more than double-digit rate of return potential for the next year or two as a combination of a very high dividend income of 3.6%. You've got growth of about 15.79%. You've got long-term growth, which I haven't showed you, which is considered to be about 15%, consistent with what you see here. And then you also have the potential for PE expansion to go from 12 times earnings up to a more normal 15 times earnings. And of course, if you look at the company historically, keep in mind from a short-term point of view, you can also see periods of time where the company appeared overvalued based on that 15 multiple, was trading at much higher valuations. So this looks like a very good entry point for the company. I think it has, really good growth potential going forward. I, like the stock at these levels. I like the income. I like the fact that the dividend's covered. So, bottom line is this is one that I think you can go ahead and start looking at now, regardless of what's going on in the market and so on. I think the company is inexpensive, and I think now would be a good entry point. Doesn't mean that Broadcom can't fall further from here. I think it's down a little bit today, if I recall correctly. But the point is, they don't ring a bell at the top or the bottom. The key is buy a stock when it has a very attractive valuation, because what attractive valuation does, and I want to close with this. See, it was attractively valued back here in the beginning. The company grew at 32%. They're slightly undervalued at the end. But if I look at long-term performance since the company's been public, by buying it at fair value, you've earned almost exactly what the company has generated as an operating company. And that's, about triple what you would have gotten in the market. So this is a very excellent company. In my opinion, it's triple B rated, triple B plus, one step short. Because of their acquisitions, I think their debt would be a concern. There are some, risk things that you want to look at. You can go to companies like Zacks and, you can look at reasons to buy. They think the semiconductor serves as a driver enabler of technological progress. I think that's important. Broadcom's focus on multiple target markets mitigates some of the risk. Acquisitions have been their most favorite mode for penetrating unexplored markets. They're currently again in the process of acquiring VMware, as I mentioned. Broadcom generates significant cash flow that enables to pay out a consistent dividend. Reasons to sell: it is in a very competitive market. They compare with giants like, Cisco and others. The revenue comes from a handful of customers. Top 5 count for more than 35%. That is a risk, but they've got the product that, continues to satisfy Apple and Samsung, for example, et cetera. Broadcoms have escalated integration risks. That's always the case with acquisitors, and acquisitions have negatively impacted their balance sheet. You can do the similar thing by going into a company like, if you're a subscriber to Morningstar, and you can go into their bulls and bears say, and they're saying their proprietary FBAR filters are well suited to handle a variety of 4G light radio frequencies. Their networking expertise has positioned the firm well, and the company continues to make reasonable acquisitions to expand its breadth. But then the bears say, they still have significant customer concentration with Apple, and that could be a problem. Pricing on RF components has been robust, but large companies like Apple and Samsung could, demand lower prices, and demand of some of Broadcom's key end markets like optical network and enterprise storage is inherently lumpy, and results may face volatility from time to time. That's all fine and good. But I also like to point out that the company, this is according to Zacks Investment Research, their semiconductor solutions were 74% of their fiscal 21. I haven't seen the number yet for 2022. Their infrastructure was 25.7%. So, semiconductor solutions is still a significant portion of what they do. Anyway, I really like the stock. I really like a stock at these levels. I hope you enjoyed this video. This has been Chuck Carnevale saying thanks for watching. Again, I hope you did enjoy the video. If you did, give me a like. Subscribe to our channel, of course. And most importantly of all, if you own stocks, you got to own Fastgraphs. Try our free trial. We're going to be expanding the product. We are constantly expanding the product's ability to help you research stocks faster and deeper and more efficiently than ever before. Thanks for watching.